Welcome back, everybody. I'm going to do a video covering the relationship of the bond market to the federal funds rate. Particularly going to focus on the 30-day or 1-month Treasury yield and show you how it correlates with Fed funds rate and basically what the bond market is actually telling about what they anticipate the Fed to do this week, tomorrow actually. Generally, every couple months, the Fed meets up and has their meeting for a couple of days. Usually runs from Tuesday to Wednesday, and then sometime around midday, afternoonish, depending on where you live, they tend to announce their decision whether to leave interest rates unchanged or to increase or decrease it. Okay, so I'm gonna go over how to tell what the bond market is actually suggesting about that. Whether they're betting on the which direction they're betting on the rate to go this week. So keep watching if you want to learn some more on this and have an idea what to expect. Okay, so this is going to be basically a chart comparing what the 1-month Treasury note yield is compared to what the federal funds rate is. Orange line will be what the Fed funds rate was from one point to another. So as you see here, it was down here at 0 all the way from 2009 to around January 2nd, 2016, perhaps. It's just how they're sorted on this, but I think it was a different day where it got changed. I remember when the Fed changed that. Anyway, as you see here, they adjusted it upward to 0.25%. The bond market basically started selling off the short-term bonds, or causing the yield to increase shortly before that actually happened. So basically, the bond market was speculating that the interest rates were getting ready to go up, so they started going up shortly before. And then come over here, and it's pretty much in lockstep with what the rate was. Looked like they were kind of betting that it might go down a little bit, back down to 0%. Shortly after that, but then just before the Fed ended up ultimately increasing the rate, you see the market actually started going the opposite direction, back upward as well, and predicting that. We'll take a better look at this on the chart, on the table, the data table I have, but generally speaking, I want you to see how this moves and how these two move pretty much in lockstep with each other. So whatever one does, the other one does for the most part. Now that wasn't always the case, because like right here, there was a lot of speculating that the Fed would increase the rate to 0.25%, but it never actually happened. And and then they settled down into here, and then finally started going up. You see here, it spiked up some there to 1.25, and then came back down briefly, and then started its way back up just before the Fed made their decision to increase. Another one here, another one here. So every time the bond market was predicting what the Fed was going to do before they actually did it. Up here, though, they were predicting that it was going to climb up to 2.5%, but it never actually did. And now, mind you, the short-term rate is at 0.02 and 0.03% neighborhood right now. So, and we were still hitting new highs with the stock prices right around here. And you've probably heard a lot of people concerned about how much higher bond yields are going to go, and then before they start causing a mass panic or something, sell off or whatever, or before they stall the economy. As you see here, we got lots of room to go. 2.5% isn't even that high. It's common for them to get all the way up to like 5 and even 6% before an actual recession comes. All right, so, but then they topped out there and then realized, okay, that was too much. Come back down to where the 2.25% rate was actually at, and then started dropping down before the rate change. And then it was kind of just in lockstep there. Maybe it was lagging a little bit a couple times more recently, and then all of a sudden it dropped for COVID-19. Okay, so now let's look at the effects of what the bond market actually did. And yeah, how soon they started changing in one direction or another relative to when the Fed actually changed their rates. So I say again, the first change I think was in 2015. All right, this thing's a little on the slow side, so I'm gonna. There we go. Okay, as you see here, bond yields are way down at like down darn near zero. You saw them getting up a little bit to 0.08 at times, even into the double-digit basis points. 12, 13 basis points there. Okay, we'll keep going down. As you see, it's we're still down way up, almost near 0%. Basically, the bond market is betting that the Fed is going to keep rates where they're at. And then they started you'll see here before long. It was here, I think it was December of 2015, if I recall. You're going to start seeing the bond rates going up, as you see here. So starting in late November of 2015, they started climbing up into the double digits and staying there. Got up to 13, 14 basis points, and then started working its way up to 20 by the end of the first week of December, and then kind of hovered around there. And then sure enough, December 16, the Fed decides to increase the rate to 0.25%. All right, so then now they're mostly in lockstep again, kind of up and down between, just kind of hovering around that 0.25% neighborhood. All right, now we're starting to see the speculation right there. It's starting to climb up above 0.3 right there. Actually, November 9, 2016 is when they started to speculate that the rate was going to go up. And sure enough, come December 14, 2016, the Fed actually did raise the rate to 0.5%. And I see by then the bond market was already getting closer to that point before that decision. Now they were up around 0.47%, or 47 basis points, if you will. So you see, the bond market a lot of times does accurately predict what's going to happen with the Fed funds rate. There's come down here to where it went up to 0.75. Sure enough, bond market was there ahead of time. They said what was coming before it actually happened. Okay, 1%. It's starting to climb up. It didn't quite get to 1% yet, but they were kind of starting to go in that direction before the actual change to 1% did happen. It looked like they spiked up to 86 basis points and then ended up at 89 the day before the Fed made their decision. Okay, now we're hovering around 1% in lockstep with the Fed funds rate. And sure enough, here we go. Another about 3 weeks or so before the Fed actually made their decision to raise the rates in 2017. December 13, 2017, more specifically. You see the 1-year bond note, or T-note, or yield, whatever, also climbing before that even happened. So they were already speculating that was going to go up to 1.25%. Okay, keep coming up. And now bond market's actually betting on it to climb all the way up to 175. Yeah, but Fed only increased it to 1.5 there on March 21st, 2018. And then it kind of settled back down a little bit, but was still elevated. I think the bond market was still expecting the Fed to increase the rate. And then they finally did. Okay, so I had a little bit of a break there. Had a distraction. My dispatcher called me, so I might have lost my little spot there, but hopefully I'm in the right spot. All right, so up here, the bond market, in October, August, September time frame of 2018, the bond market was basically betting that the Fed was going to raise rates to 2% before it ever actually happened. Started even getting a little bit above 2%, even wondering if it might go up to 2.25%. And next thing you know, on the 9/26, of 2018, the Fed did end up raising the rate to 2%. Okay, so you see up now get up in here, starting to get up closer to 2.25, which means that the bond market is making bets that the Fed's going to raise the rate to 2.25. And it even got up above, up into 236, 237, 238 range. So they were kind of split between, is the Fed going to raise it to 2.25 or 2.5? They weren't really sure at that time, but they were pretty sure it was going to be one of the two. So that's why the 1 month bond yield ended up in that neighborhood. Okay, it keeps coming down here to 2019. Bond yields ended up again climbing up closer to starting to work their way up halfway or so between 225 and 250, which is another indication that the bond market is confused, but they're pretty sure it's going to be between 2.25 and 2.5 at the next Fed decision. You get over here to March 21st of 2019, finally start seeing above 2.5 on the bond market yield. Still at 225 on the Fed funds rate. Now, keep in mind the Fed only meets up every couple of months to have their discussions about what to do with these interest rates, the Fed funds rate. But basically, the bond market was suggesting that they were pretty confident that the Fed was going to go up to 2.5. Then it came back down where this is an indication that they're unsure. Maybe they'll go up to 2.5, or maybe they'll stay at 225. They weren't really completely sure of it yet. And then it got to where maybe it's going to drop to 2% instead of staying at 225. Might have been when President Trump was mad at the Fed for being too aggressive, I guess, with their Fed rate policy. I don't remember for sure. I don't want to get into the politics of that. Everybody has their own play on that, and then everybody has between the president and the Fed and everybody else involved, people in power have different takes on what's going on. Also, so do investors. And the bond market primarily is driven by investors, foreign or domestic, or it's not always government entities involved. But anyway, it's see here. Bond market again was kind of bringing the yields back down again, like thinking, oh, maybe they're going to drop it down to 2.0. And sure enough, right before the Fed actually did lower rates to 2 in July of 2019, the bond market was working in that direction before it even happened. Okay, coming down here, the bond market got caught by surprise by this one. They didn't predict that was going to go down to 1.75 until it already happened. But they did start to speculate right at the very last minute before the Fed made their decision to go from 175 to 150. And we see then the bond market looked like it started to speculate maybe it'll go back up, but then came back down. And then right before it went down, it started to sell off very quickly, and at the start of the COVID-19 pandemic, lost 30 basis points right there in a single day from 141 to 111. Fed ended up dropping the Fed funds rate down from 1.5 to 1 that same day. And bond market here, see, they're already, before the Fed even dropped it from 1 all the way back down to 0, bond market was already working their way down that way. They had gotten down to 0.25% by the time the Fed decided to bring it down to 0. So the bond market was always up ahead of the game. I always knew what the Fed was going to do before it even ever happened, except for a couple of occasions here. Now, since that point, there was a point here in April of 2020 where the bond investors seemed to be thinking that it might go back up to 0.25% by around that time, and then it dropped back down. And then they're kind of a little bit halfway. It's kind of making bets in between 0 and 0.25%, but maybe a little bit more towards 0%. It's not with a lot of confidence. That's why if you find the middle ground and they're a little bit to the lower side of middle, then that's basically they're unsure if it's going to stay at 0 or go up to 0.25%, but they're kind of leaning towards 0 a little bit. and started getting up here to 11, 12, 13, 14, 15 basis point range, which is a little more confidence that they might go up to 0.25%, but not enough to raise the yield all the way up to 25 basis points before the Fed actually decided to make any decisions. All right, and rates came back down into about the 10 or so basis point neighborhood, give or take some, and nothing ever happened with the Fed. Keep coming all the way down, and we're seeing a lot of 7, 8, 9, 10 kind of basis points over here on the bond market. And around here, January 26th of this year, it started to come back down into the 5 neighborhood, and which is more of an indication that the bond market is making bets that the Fed is not going to change the rate. All right. So, and then and now it's been staying around 2, 3, 4, even 5 basis points. And as of March 15, it's way down at 0.02%. Okay, so ultimately what the bond market is telling me right now is they believe the Fed is going to leave rates unchanged tomorrow. I'm recording this Tuesday. Fed will be making an announcement Wednesday, tomorrow, on what they're going to do. There is some misleading info, though, because I have seen some talk from Fed officials. I don't remember if it was Jerome Powell himself or somebody else. There was talk about, and in order to keep the long-term bond yields from going up too high, they can sell off the short-term bonds and then use that to buy long-term bonds to help suppress those. And that's usually what leads to a tightening of the yield curve, the bond yield curve. And this is just classic textbook strategy used by the Fed, actually, when it comes to inflation. You'll see the short-term rates going up, which is a result of of bonds being sold on that end, and the money gets freed up to buy long-term bonds, which helps slow them down from growing more, or might even get them to come down a little bit. Whatever the case, it does tend to cause the yield curve to flatten some more, and then over a longer period of time, you can see a yield curve inversion. Now, yield curve inversion means that the short-term bond yields are higher than the long-term bonds, and usually when that happens, within about, I think it was 9 to 24 months after that actually happens, typically with the 2-year and 10-year bond yields is what investors like to look at, but there are some others that also get looked at as well. But generally, if you see an inversion of the 2 versus 10, then usually within about 9 to 24 months after that, a recession does tend to come. It doesn't mean that one will come, because they don't always come after that. But there's a greater chance that one could come within the next 9 to 24 months. Doesn't mean the stock market's going to stop climbing at that point in time. It just means that the snowball might start rolling that could cause the economy to stall at that point in the future once that happens. And part of that is because of again, smaller companies they rely more on loans, and when the interest rates get too high, they have a harder time affording their loans that they need to expand their businesses. And then when the short-term rates get higher than the long-term, it becomes less cost-effective for the financial institutions to lend money, because what they a lot of times will do is borrow money on the short end and then lend it back out on the long end to help leverage their profits. So if it's kind of like a cost of doing business. Borrowing money from other sources so they can keep having supply of money available to lend to others on the long end for like home mortgages or business investments or anything along that line. Okay, so that's what we're usually going to end up looking for once the inversion actually does happen, and also when the yields actually get high enough. So you've not seen anything yet. 2.25% isn't even, it's about as high as it got between the Great Recession and now, and even that wasn't even half as high as what we usually see bond yields get before a recession comes. So no reason to get in a panic over the stuff that goes on here. Some of you guys might get opportunity to swing trade based on that, but it's again, it's always a risk, especially when stock earnings yields are up around 18%, even maybe 19% by now. That's too much strong growth. I would not be trying to swing trade between the stock and bond funds and vice versa right at the moment. There's too much risk. Yeah, you can take advantage of volatility, but what's the chances that you're going to get the volatility and the price drop that you want? Because don't forget, volatility goes in both directions, not just down. It goes up too. All right. So that's all I have for words of advice for you guys all today. Again, just stay. I recommend staying long in stock positions or stock fund positions, whatever. If you're a TSP investor or IRA investor, whatever. Don't be afraid of any drops that might come. We got more price gains coming, and more so. I want to make sure you guys have a good understanding of how the bond market and the Fed funds rate or the Fed, their rate policies actually correlate with each other. All right, so let me know if you have any questions or comments, whatever, and we'll see you guys on the next one. Thanks.